Hello, everyone. Welcome back to another installment of our Lunch and Learn webinar series. I'm your host, Mayur Thaker. I am an analyst and a portfolio manager at Zacks Investment Research. I manage the Zacks Earnings Certain family of portfolios, as well as the Zacks Deep Value portfolio. And we're going to be talking about perhaps the most important and most powerful tool in any long-term investor's toolbox. And this is a concept that I've been talking about for many years now. It's a concept in investing that I think doesn't get anywhere near enough attention and time from investors, and that is the concept and principle and formula known as return on invested capital, also known as ROIC. So let's get started with looking at what this is, why it's important, and a couple of practical use cases on how we can use it in our everyday investment selection process. So first off, perhaps, the most legendary investor, one of the most legendary investors of our time, Charlie Munger, rest in peace. He, has talked about ROIC over the years, repeatedly. And here's a quote that I think is important for everyone to really grasp and understand, where he wrote, "Over the long term, it's hard for a stock to earn a much better return than the business which underlies it earns. If the business earns 6% on capital over 40 years and you hold it for that 40 years, you're not going to make much different than a 6% return, even if you originally buy it at a huge discount. Conversely, if a business earns 18% on capital over 20 or 30 years, even if you pay an expensive looking price, you'll end up with one hell of a result." So this is very important for us to understand as to why that is. Ultimately, what Charlie, is saying here is that the return that you earn on your investment over the very long haul. Now, this is not true for short periods. It's not true for a year or two. It may not even be true for over 5 years, but over the ultra long term, over an entire lifetime, say 40 years, even 30 years. Um, the return that you will earn from a stock will roughly be in line with the return that that business earns on its own capital. So whatever its return on its own invested capital is over that 30-year time span is going to be roughly what the returns are that you will earn on your investment in the stock. This is a mathematical principle, and we're going to take a look at exactly why, that is. But mathematically, that is a sort of, kind of like a statement of fact, because you can't earn a return on your investment that significantly exceeds or falls short of the capital, the earnings that that business generates on its own capital. So we'll take a look at why that is. But overall, Charlie Munger has repeatedly stressed that sustained high returns on capital are a hallmark of a truly great business. So, paraphrase, that means that a business compounding at 20% ROIC for many years mathematically crushes a 6 to 8% ROIC business, even if you pay a fair or even a slightly high price up front. Now, again, that assumes, the two businesses have roughly the same opportunity set. The two companies are retaining their capital and reinvesting at the same rate. Then, of course, yes, a company that has a high ROIC will mathematically beat a company that generates a low ROIC. Now, we will look at a couple of nuances around that. Sometimes it is possible that a 10% ROIC company can outperform a 20% ROIC company, and we'll look at that. But what Charlie, was referring to here is that if two companies are both reinvesting their capital, um, then the one that generates a higher ROIC mathematically will outperform the one that's generating a lower ROIC. So long-term ROIC is one of the best indicators of whether or not a company truly has an economic moat around their business. This is the main reason why we focus on ROIC. Of course, mathematically, higher ROIC companies compound their capital at a higher rate over time. But remember, uh, that can be true for a year or two, maybe 3 years, maybe even 5 years. But eventually, what typically happens to most businesses is that if you have a high ROIC for a couple of years, what that means is that that's going to start attracting a lot of attention. You might be the first mover, but if you're doing something that's easily replicable by others, if you're doing something that doesn't have a strong moat around it, then that attractive activity that you're doing in your business is just going to be competed away by new entrants that come in and see, hold up, you guys are earning 20% returns on capital because you, I don't know, created a lemonade business. Well, why don't we try to replicate that? Why don't we do that? Just like that. And eventually what happens is, new entrants come in and whatever advantage that you had gets eroded away. So that's why high ROIC is important, but long-term sustained high ROIC is a lot rarer. And that is truly one of the best indicators of whether or not a company truly has an economic moat. So that means that you can sustain high ROIC for a long period of time. So high ROIC is step number one, but then sustained high ROIC is step number two. And then there are a couple of steps after that. So we will talk about the full framework of thinking in just a few slides here. But remember, high ROIC, very important, but sustained long-term ROIC um, is one of the best indications that the business has something that is not easily copied by other companies. So what is ROIC? ROIC, simply put, is net operating profit after tax. It's also called NOPAT, divided by invested capital. Okay, so I know that's a mouthful if you're in a sort of new to this concept, but basically what this is saying is we want to look at um, earnings before interest and taxes. We subtract out the taxes, so that gives you earnings after tax, but before interest expense. Okay. So also what you can just do as a shorthand around this is you just take the net income of the company, adjust it for any one-time items, and you add back interest expense. That is basically NOPAT, if you just want to make a shortcut out of it. So that's the numerator. Basically, it's your earnings after tax, but before the impact of one-time items, extraordinary expenses, one-time sort of hits to net income, or even one-time tailwinds to net income. But add back the interest expense as well, because interest expense is something that is impacted by your capital budgeting decisions. So we want to remove that impact. So basically, net operating profit after tax is your net income plus extraordinary items, one-time items, plus interest expense. That's basically it. And then the denominator of the equation is invested capital. That is directly from your balance sheet. Essentially, that is your total assets um, minus current liabilities, and then you add back any interest-bearing debt obligations, such as, short-term debt and, capital leases, things like that. So what this is telling you is that it's giving you how much profit are you generating per dollar of capital that you have invested in your business, in a nutshell. Measures how efficiently a company turns all capital from debt and equity providers into after-tax operating profit. Okay. So unlike earnings per share, which is where all of the focus goes to, if you turn on financial media, CNBC, Bloomberg, earnings per share dominates all of the discussion. And no doubt, earnings per share is obviously very important. That tells you the cash flow that the company is generating, the earnings that the company is throwing off. But ROIC controls for how much capital is tied up in the business. It's a direct lens on value creation versus just growth alone. To be a successful investor in the long run, I think you have to do both growth analysis and ROIC. Okay. A business can invest its cash, right? Because if you're just focused on growth, okay, a business, what they can do is they can just invest its cash into a simple high yield savings account and compound its capital at 3.5%. That's roughly what a high yield savings account would give you today. But does this create shareholder value in the market? Ultimately, if a company cannot sustainably earn a return on its invested capital above its cost of capital, it destroys shareholder value. Companies also manufacture growth by acquisitions, but astute investors who pay attention to ROIC know precisely when such an acquisition is value destructive. Why? Because while growth is clearly important, it should not be outside of the context of ROIC, within the context of a high ROIC. So we want growth with high ROIC together. That is the most important takeaway from this entire presentation today. We want growth. Obviously, the growth is very important. That's what generates returns. But if that growth is coming at a high cost, that growth might be value destructive. If that's, I know that's, something that not many investors or media talk about, but growth isn't everything. We want growth at a high ROI within the context of high ROIC. So great businesses are ones who grow at a high ROIC minus weighted average cost of capital spread. So as a quick example, let's take an example here of a company that starts out with $10,000 of capital. Okay, so we have the invested capital in black bars here, starting at $10,000, and let's say they earn 3.5% every year. So that means that they grow earnings at 3.5% every single year. So you can see the yellow bars are the cash flow. That's on the right-hand side of the chart. You can see after the first year, they generated $350 on that $10,000 of capital, and that then compounds at 3.5% every single year. So you can see a really nice growth curve here. Every year, the company grows its earnings, its net earnings, steadily every single year, year in, year out. So you might say, well, that looks good. I mean, this is a company that's steadily growing every single year. It's very, um, steady, very predictable, and it's a relatively safe company. Um, but is this a good business? If you look at just the growth itself, it looks like a good growing company. Even though it's a slow growing company, it's still a growing company that's steady and one that you can predict with a high degree of certainty. So to me, this looks like a good business, especially for dividend investors, investors that are more conservative, investors that want predictability over, high returns. Is this a good business to invest in? The answer to that is no, because this is a company that earns 3.5%. Why would you invest in a company that is earning 3.5% when you can just take your money, put it into a CD and earn the same amount of returns every year. So what's the point of investing in a company that's doing 3.5% when you can do that yourself? You can just buy a money market fund, or just open up a high interest savings account and just generate the same exact returns on your own. You don't need a management team to do that for you. You don't need to invest in, a stock that, has some degree of risk, right? If you have $10,000, you can just put it into a savings account and it will never go down in value. It will keep compounding at 3.5%. Whereas if you buy a stock, even if they're doing 3.5%, again, stocks have inherent risk. That stock can go down, from day to day. Even though it may not go down by as much as the market, it'll still go down. So why, take risk with a stock that's earning a 3.5% return on its capital when you can do that yourself and you'll never see your balance ever go down. You'll only see it go up every single month. So this is why growth by itself is not enough information. We want to know what return, um, what was the cost of that growth, right? We want to know how much capital it required for the company to grow the way that it did. And so that's why we want to look at how much capital did the business have in order to grow at that stated growth rate. So this is a ROIC of 3.5%. So that is the ROIC that you would earn if you just parked your money into a savings account, right? But we want, better returns than that, right? Obviously, if we buy a stock, um, the idea is that management has more attractive returns, more attractive opportunities than, simply buying a money market mutual fund, right? So that's why ROIC is the most important metric first and foremost. Why? Because that means that instead of investing in a savings account, you are giving your money to a management team that can allocate your capital and earn a much higher return than what you could do by yourself, investing in a risk-free asset. So ultimately, when we buy a stock, we want some assurance that management can earn a return on invested capital that exceeds its weighted average cost of capital. And a big component of weighted average cost of capital is the risk-free rate. Right now, the risk-free rate is roughly 3.5%, 3.5 to 4%. Obviously, we want a little bit more than that. The 10-year Treasury yield, currently yields, I don't know, 4% right now. So obviously, when we buy a stock, we want to own a company that generates a return on its invested capital that is significantly above, say, 4%. Because otherwise, why should you buy it? Why do you want to give your money to a management team that can't even beat the 10-year Treasury yield in terms of its return over 10 years? So if we learn the order of operations, it helps it, become very clear, right? Every business starts as an idea only on paper, as an idea in your head, and then on paper as a business model. Then, to make that idea into reality, we need investors, private equity investors, maybe lenders at that early stage, um, to make investments in property, equipment, working capital, etc., to transform that idea into reality, to make it a viable business, right? That is your invested capital, the amount of capital that was invested to make that idea into reality. Then you have a product or service that generates revenue. And then ultimately, once the expenses are paid, like the cost of the inventory, the cost of, hiring people to work for you, the cost of any rent that you paid, things like that, then you have operating profit. So the ROIC of the company is your operating profit divided by the amount of investment that you had to make to generate that operating profit in the first place. So that is the basic ROIC formula. That is your operating income times one minus your tax rate. So that's operating income after tax divided by the invested capital, right? That's the total amount of capital that was invested in the company. And we can get, a little bit more specific here. Basically, it's your net working capital, right? Total assets, current assets minus current liabilities, plus your long-term assets, like your plant, property, and equipment, plus capitalized intangibles, goodwill, R&D, other adjustments, minus your excess cash. That gives you invested capital. So ROIC is best compared to the firm's cost of capital. That's the weighted average cost of capital to judge whether growth creates or destroys value. This is very important. We must have a business that generates an ROIC that exceeds the cost of that capital, right? Because as an investor, we want a certain minimum return. Um, and as a debt investor, for example, if it's a big company and they have bonds that trade, right, in the marketplace, that debt is directly observable in the market. So let's say a company XYZ issues a bond, and that bond in the marketplace fetches a 6% yield. That tells you that the cost of debt is 6%. The cost of equity might be around 7, maybe 8%. And assuming it's a 50-50 capital structure, 50% debt, 50% equity, your cost of capital is roughly 7%, right? 6% cost of debt, 8% cost of equity, 50-50 capital structure. That means that your weighted average cost of capital is the average of 6 and 8. That's 7%. That is the company's weighted average cost of capital. So when we buy this company, we want an assurance, we want evidence that they are generating a return on invested capital that exceeds that 7%. So we want a company that generates something more than 7%, right? Because then that's what creates value. If you are borrowing, say, at 6%, say, for example, you bought an investment property and the cost of your mortgage, right, to buy that investment property is 6%, which is roughly what the mortgage rate is right now. But then the return that you generate from your investment property is 5%. Is that a good deal for you? Probably not. Um, you'd have to wait years and years. You'd have to wait 30 plus years for you to pay off that mortgage, um, assuming you don't, send in additional principal payments. It would take you 30 years, right, to pay it off using your own capital too, out of pocket, for you to start generating a return, right? That 5%. So you're earning a return that's less than what it costed you to borrow that money in the first place. Is that a good deal for you? No, right? You want a return, meaning the rent should generate something more than 6% so that you can cover your cost and earn an economic profit, meaning a profit that exceeds the cost that you had to pay out of pocket for yourself, out of to acquire the property in the first place. So in the same way, a business should earn a return on capital that exceeds the cost that company incurred to raise capital in the first place from either debt investors or equity investors or both. This is a very basic concept. So Michael Mauboussin, I think I'm butchering his last name here, but he is one of my favorite investors who has taken the concept of ROIC and created a practical framework around it. I highly recommend everybody who is interested in ROIC to read his white papers that he's written over the years. He's been writing about ROIC incessantly for 20 years now. He's written a number of white papers on it that provides a practical framework. But basically, Michael Mauboussin has stated, a company creates value when $1 invested in the business is worth more than $1 in the market, right? This means that a company that generates an ROIC above the opportunity cost of capital is generating an economic profit. Okay, if it generates an economic profit, it will generate a positive return in the market, meaning every dollar of invested capital will fetch a market value above what was deployed into the company. And if a company generates an ROIC below its opportunity cost of capital, it is value destructive, regardless of how much it grows. So this is very important to grasp as a concept. A company could be growing earnings at 10 to 15% year in, year out. But if it's generating that growth on an ROIC at 3%, 4%, 5%, it's likely that it's destroying value because it's not earning a return that's above the cost of acquiring that capital in the first place. That's value destructive. That's like I said in my mortgage example, it's like taking it's like buying an investment property, paying a 6% mortgage rate and earning rent income divided by your total cost of say 4%. So you're paying 6% out the door, but only earning a 4% cap rate. That, would be value destructive. You want to earn something above the cost of borrowing that capital in the first place. So Malbosson emphasizes that, get the denominator right. And then ROIC tends to regress towards the mean. Very high or very low ROIC levels are rarely permanent, but that's the point of an astute, quality-oriented investor. We want to find companies, the rare companies out there that don't have regression towards the mean. Most companies do. Most businesses are average. But we want to find the exceptional ones out there that have permanency in high ROIC and the ability of management to continue to deploy capital at that high ROIC over many years of time. That's what our goal is as an investor. So again, growth only adds value when ROIC exceeds the cost of capital and destroys value when ROIC is below the cost of capital. We want to find the companies that can do this for a sustained period of time. ROIC above the cost of capital. We want and the way that we can find that usually is when a company creates differentiation, that there's pricing power, there's brand value, there's high switching costs. Sometimes there's also permanency in high ROIC when there's cost leadership. The first examples that come to mind, Costco and Walmart, they have cost leadership. They have structurally lower unit costs versus their peers. That gives you a lot of permanency as well in ROIC exceeding the cost of capital for a long period of time. So high EPS with low ROIC often reflects, very high capital intensity, value destroying M&A, poor working capital discipline. Lower EPS but high stable ROIC often reflects disciplined capital allocation, pricing power, and rational reinvestment. Okay, so ROIC captures how much capital it took to earn those profits, not just the size of the income statement. So again, we want a blend of both. We want a blend of growth and ROIC that exceeds the cost of capital, sustained over a long period of time. ROIC and long-term equity returns, there's strong evidence, studies, and practitioner work from Morgan Stanley, from Michael Mabosson, find that Companies with high and stable ROIC tend to outperform over long time horizons versus low ROIC peers, even after controlling for sector. Portfolios tilted towards high ROIC, high spread firms have historically delivered higher returns with lower drawdowns than the broad market. So this is again very important as an investor. We want to find companies that can sustainably generate high returns on invested capital. ROIC is strongly correlated with valuation multiples. High ROIC firms generally trade at higher price to book multiples and higher enterprise value to EBIT multiples than low ROIC firms. Yet, even after paying higher multiples, investors in persistently high ROIC firms often earn excess returns because the level of ROIC is higher than the market embeds. The duration of excess ROIC is longer than expected. This is why duration also matters. We want high ROIC, but we also want high duration, high ROIC. So that's the absolute key here. The absolute takeaway here is that a business must earn an ROIC above its cost of capital. And for most companies, by the way, that's usually around 6 to 8%. For most large companies, the ballpark is 6 to 8%. So we want companies that earn something higher than 6 to 8%. However, there's also a caveat here because sometimes a company that earns 20% ROIC on a fixed capital base is not necessarily superior to a company that earns 10% ROIC on a rapidly growing capital base. Here are two examples of companies here. A company at the top, you can see earns ROIC well above 35%, right? It's about 37%. But on the right-hand side, you can see the invested capital base isn't growing much at all, meaning they're not deploying much capital here. Um, so they're earning a very lucrative ROIC, but with no growth opportunities. They're not really reinvesting capital to grow. Whereas Thermo Fisher, which is another example, the example here on the top here is Altria Group. Altria obviously is well known for tobacco and now e-cigarettes. But you can see the tobacco industry is not really a growing industry. It's really just a cash cow industry. Um, the business is mostly stagnant, in terms of its opportunity set to grow. That's why they don't really need to grow and reinvest capital. That's why their capital base is mostly stagnant over time. This is a 15-year chart of their capital base, the invested capital. They don't really reinvest to grow, but they certainly are generating high return on that capital for sure. Whereas Thermo Fisher only earns roughly an 11% ROIC, but you can see that they continuously reinvest capital to grow the business. So this is a compound growth story, a company that does earn an ROIC that exceeds the cost of capital. Remember, cost of capital for most companies is 6 to 8%. So they are covering that spread here. They are generating something above that, and they're continuously compounding the balance sheet at that positive spread. So over time, even though Altria generates 3 times the ROIC, Thermo Fisher possibly will be the outperformer over time because you can see that they also have a positive economic spread, but they compound the balance sheet at roughly 5, 6, 7% every single year. So that's why once that positive spread has been established, the company that can deploy the most amount of capital generates the most growth in economic profit and therefore creates the most shareholder value. So stated differently, a 10% ROIC business, like what we just saw for Thermo Fisher, can still dramatically outperform a 30% ROIC business like we saw for Altria if the 10% business is allocating vastly more capital each year. Okay, so this is very important. So the key question here is, does management, once this has been established, right? Once ROIC is above the weighted average cost of capital, once that basic yes or no, that binary, um, question has been answered, once the answer is yes, okay, set apart how big that spread is. Once that answer is yes, the key question then becomes, does management have the capability to capitalize on a large opportunity? Yes or no? Obviously, for tobacco, that answer is no. There's not much of an opportunity for them to be pursuing, to compound capital, to reinvest cash flows, to generate more and more growth each year, whereas Thermo Fisher continuously finds new opportunities to grow at a high ROIC each and every single year. That is the key question. That is where we want to be. And that's why we own Thermo Fisher in our in our Zacks Earning Certain portfolio of high quality businesses, but we don't own Altria Group. Not to say that Altria is a bad business, not at all. It's quite stable business. We may actually even consider it in the future for our portfolio, but I'm just trying to highlight the difference between a company that compounds its balance sheet by reinvesting cash flows and a company that does not reinvest its cash flows. There is a potential for a lower ROIC business to outperform a higher ROIC business as long as the ROIC exceeds the cost of capital. So practical ROIC calculation issues, I won't spend too much time here, but these are common adjustments that Michael Mauboussin does, mention. He does like to remove excess cash from invested capital that, kind of, makes comparability a little bit better between companies. Companies that might just be hoarding cash right now might be doing so because they are seeing less opportunities out there, and so they want to just be a little bit more conservative in their capital allocation um, decision making, whereas others might be a little bit more cavalier with their capital allocation decision making. So to adjust for that, we remove excess cash, so it makes comparability a little bit better, more direct. Sometimes R&D is an asset, but because due to GAAP rules, R&D is expensed in most cases. So to make an important adjustment, we can capitalize R&D ourselves in our ROIC calculation. Instead of expensing our R&D, we move it to the denominator, which is the invested capital base, and that usually increases the ROIC for many companies, especially software companies out there, but even other companies too, like industrials. Adjust for leases. So these are all adjustments that we do here at Zacks when we build our portfolios that are based on ROIC, specifically the Zacks Earning Certain family of portfolios here. ROIC versus other quality metrics, ROIC versus ROE. This is a very common thing. A lot of people do use ROE. However, ROE is sensitive to leverage. ROIC is capital structure neutral. We like to look at how is the company generating returns, regardless of whether they're using debt or not. We want to know whether the company has a true moat or not. High ROE does not necessarily mean that you have a moat around your company, because you might just be an average business, but you're just simply using a lot of debt to enhance the returns to shareholders. That can definitely be a good thing. I mean, that can be a good thing for medium-term returns, but We want to know whether what you're doing is something that's truly exceptional that nobody else can really replicate. And so ROIC does a better job at highlighting that. ROIC versus margins. Margins are very important too, but I still believe very strongly that ROIC is better than margin. High margins um, just tell you, that you have good cost discipline, but sometimes low margin businesses can be high ROIC businesses. That's very much, the case here. Um, we have, one specific company, Cencora. They are the largest drug distributor in the world, at least in the Western world. Um, they are a very low margin business because they are simply a drug distributor. They have a very, very um, large network effect, but it's a very high margin business because they don't require a lot of capital. So it is a low margin but high ROIC business, and that's why it becomes a very great business to own for investors. So we don't necessarily want to be tied up with margins. ROIC is a higher signal, a more important signal than even profit margins can be. And as we already established, growth is very important, but growth at a ROIC that is below the cost of capital destroys value. So we want growth within the context of high ROIC. So this is why we use ROIC as a central part of our investment discipline in the Zacks Earning Certain proxy of portfolios here. ROIC in different industries, capital light sectors like software often show high ROIC. Capital intensive sectors like utilities and heavy industries, they show lower ROIC, but that's not necessarily bad. Like I said, the most important thing is that the ROIC has to be above the cost of capital. That's the most important thing. Then the next best question becomes how much can management deploy at that positive ROIC spread? That's where growth, starts to come in. And then of course, the other question is how long can that last? We want companies that can earn a positive spread for a very, very long time. And those are the companies that have a true moat around the business. And that's what Munger is saying here. Munger's core message has always been own a few truly outstanding businesses that can reinvest at high rates for a long time. That's the very key takeaway there. ROIC is the quantitative expression of that idea. There are some limitations and pitfalls. ROIC is backward looking. It can't by itself predict the future, but that's why we look and perform some qualitative, analysis. We want to buy companies that are doing something that is not discretionary. We want to find companies that are building products and services that are always in demand. And if they have shown a high ROIC to WACC spread for many, many years, it means that they're doing something that simply isn't replicable. And so that's why ROIC can be a forward-looking indicator if you perform those additional checks and balances. So in summary, ROIC is a central metric that links business quality, growth, and long-term equity returns. It is the most important tool in a long-term investor's toolkit. Charlie Munger has emphasized high sustainable returns on capital as a key investment criteria, and Michael Mabason's analytical framework around ROIC and competitive dynamics are, deeply aligned with that. So for investors, the practical questions is not just is ROIC high, but why is it high? Are they doing something that is required versus discretionary? how long can it stay high, right? That is another key question as to whether they're doing something that is required by their customers versus a discretionary expense for their customers. What is that spread versus the cost of capital? And what price am I paying for that stream of excess returns? That last question isn't as important um, if you have the other questions answered, with certainty. So that's why we here at Zacks, we maintain a portfolio of high quality businesses that we believe satisfy the core tenets of the ROIC framework. We want high ROIC, meaning an ROIC that exceeds their cost of capital. We want a durable ROIC, a company that durably and sustainably generates that positive spread. We also want strong free cash flow conversion. That gets into the cash accounting versus accrual accounting, debate there. Accounting issues can be a concern in many cases. That's why we want free cash flow that confirms that the numerator of the equation there, the operating profit. We want free cash flow to confirm operating profit. That gives us even greater confidence in the quality of the reported ROIC. So all three of these together gives us the Zacks Earning Certain proxy, which is a collection of high quality companies. Here you can see the average return on invested capital based on the analytical framework proposed by Michael Mabosson. I have basically replicated or basically followed his framework of thinking on how to calculate returns on invested capital. And here you can see that the average company over time, not only does this portfolio generate a positive spread, right? You can see that, we're mostly between 13.5 to 15% average returns on invested capital, but you can see that it's been that way for 10 plus years, right? So that goes to the sustainability of that high spread between the return on invested capital and the weighted average cost of capital. Like I mentioned, most large cap companies, the weighted average cost of capital is somewhere between 6 to 8%. So we want a company generating more than that for a long period of time. And so these companies that we have in our portfolio have done exactly that. They have earned a positive spread, and they've done that positive spread for many, many years, 10 plus years. In fact, they've been doing it for 20 years. That's usually our goal, is looking for companies that can do that for 20 years, but at the very least 10 years. When you generate a positive return on invested capital spread versus the weighted average cost of capital for 10 years, it means that you're doing something that's not easily copied by the competition. So high and durable ROIC, high earnings per share linearity, high and consistent free cash flow conversion. These are the principles behind the Zacks Earning Certain proxy. So we seek to pick companies that not only demonstrate high ROIC right now, but have proven to deliver high ROIC consistently in the past. Here you can see an example of that. IDEX Laboratories, a compounding machine in pet care. IDEX has been a part of the portfolio for years and years. You can see they generate 40% ROIC, and they do that on an increasing capital base, as you can see on the right-hand side of the chart. This is a stellar example of a company that does something that is required, right? We love our pets, we love our cats and dogs. Um, so they provide, pet care services that are critical and required, and do them very, very profitably, as you can see with their very high ROIC. And they continue to compound the business by reinvesting cash flows to grow at an increasing rate of return at a very positive and lucrative spread to the cost of capital. So this is again a exhibit A of a company that we look for in the Zacks earning certain methodology. Another example of Fastenal, another compounding machine in industrials. Look at the beauty of that. A company that generates nearly 30% returns on invested capital, and they do it sustainably over time, over 10 plus years. And you can see on the right-hand side of the chart that the company continuously reinvests capital. Um, the management team continuously finds new areas, new places to reinvest to grow the business. Again, that is what we call compounding. That is a compounding machine if we've ever seen them. IDEX Labs, Fastenal, two stellar examples of high ROIC, high sustainability in ROIC, and high reinvesting compounding machine that has done this for many, many years. So steady growth plus durable ROIC, that is the dual engine of shareholder value creation. Here you can see a chart of the Zacks earnings certain proxy. You can see the earnings per share linearity over time. The Zacks earnings certain proxy is therefore a collection of 60 such hand-picked businesses we believe are high quality, long-term compounders that deliver high and sustainable ROIC alongside steady growth. That is the dual engine of long-term investment results. So we hope you found this presentation helpful. If you have any questions about return on invested capital, the concept, how we calculate it in practice, and how we build the Zacks earning certain proxy portfolio. If you have any questions regarding that portfolio and other model portfolios that we maintain here at Zacks, please do give us a call at 1-866-794-6065 or send us an email to researchdesk@zackspro.com. Thanks everyone, and hope to see you on the next call.